Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
There are things going on both sides here, the United States and China. Both have some accurate statements that they've made. The Trump administration is clearly frustrated with China, that it's not living up to the May 12th agreement, and in particular, that it's slowing down access to rare earth magnets and other critical minerals, which are needed for so many different segments of manufacturing. Now, MOFCOM, of course, has pushed back and said that it's the United States that is escalating the situation.
I don't think that we should expect another 5% or 6% upside month, but I do think that there's a lot of bullish momentum in the markets right now. And if there was any type of consolidation or a reset, I think it would be a viable pullback.
We're seeing some contraction with those ISM numbers under 50. It was expected. I don't think it was off that much where it's going to cause much fear in this market. We're still more concerned about anything that comes out of Washington on the tariff front than, the hard data. But that hard data is impacted by tariffs, and we've yet to see them really have that impact. I think the jobs numbers at the end of the week, not just the unemployment number, but the jobless claims, that ticked up surprisingly last week. If we get above 250, that to me would be a little head scratching.
We got 1 hour to go until the market close, so let us take a look at the major averages. We have a mixed picture here. The Dow is lower, but sort of coming back to the unchanged level. It's only down about 18 points right now. The S&P 500 just peeking into the green a little bit more solidly, up 1/3 after being lower for much of the session. The NASDAQ up. It's been the winner of the three, both really over the last month, but also today. Big tech has been driving gains. Looking at the S&P 500, I'm going to look at the 1 month because we don't just have May. But it was the best May for the S&P 500 going back something like 30 years. So really had a strong May.
Yeah, I mean, that's the point, Jeremy. You are coming off what was a solid month for stocks. I mean, just to put a number on it, I think it was Jared Blickery, our colleague, who said actually the S&P 500 best May, I think he said in 35 years.
35 years,
a remarkable move there. Today, listen, different cross currents we could talk about. I think you'd have to mention, though, how trade does still seem to be front and center in a few different ways. I mean, one, you have U.S. and China. They're trading these barbs back and forth, these allegations. Who exactly is responsible for violating this temporary trade agreement, we'll call it. But then we had a report also that Trump and Xi likely to speak this week. So I think investors are wondering, does that happen? When it does happen, what could possibly come of that?
Yeah.
And then, of course, not just U.S. and China. We also know U.S. and EU are in focus because, of course, Trump's saying, listen, he's going to double those steel tariffs to 50%.
Right, and how is the TACO acronym, Trump always chickens out, how is that playing out in the markets? And how is it affecting Trump's psyche, right? He didn't like it when it was brought up to him.
No, he didn't.
With a reporter.
No,
Just a quick check on some of the other asset classes. We are seeing yields move up a little bit. We did get manufacturing data this morning. You see here yields ticking back up towards 4.5%, and the U.S. dollar index on the flip side is trading a little bit lower. Moving on over to checking on some stocks here. The Magnificent Seven really powering a lot of the gains that we saw in May. We're going to talk more about that throughout the show. Meta higher today on a report that it's moving even more towards AI tools with its ad services that it offers. Those shares up 3.5%. NVIDIA up another 2% today. So, and actually, I want to mention Broadcom as well, which is reporting this week. Those shares are close to a record.
And interesting to see kind of Apple just edging in the green there, because if you look over the past month, if you looked at, for example, the MAGs, the ETF that tracks the MAG 7, that's had a nice pop. But Apple has really struggled here.
Yeah.
We'll talk to a smart tech analyst or two, actually, about that.
Yeah, that has been the laggard. And then quickly, I was going to show sectors, but you know what? I'm going to do it now. Yeah. Sectors in the S&P today. Industrials and healthcare, the worst performers. Energy having a pretty good comeback there, up by 1.2%, and tech joining it as well.
All right, so let's get more on the latest market moves now. I want to welcome in Kenny Polcari, Slatestone Wealth Chief Market Strategist. Kenny, it is good to see you. So I saw, Kenny, that you are making the argument, my friend, that we cannot surge higher here, Kenny, unless we get a real trade deal. Not a trade truce,
Right.
Not a trade reprieve, not a trade handshake, but a real trade deal. That's what it's going to take if we want to surge higher, Kenny.
Well, that's what it's going to take if the market's finally going to get comfortable with the deals are getting done. Because right now, all we've had on any of this is just a handshake agreement or an understanding. And look what's happened. China came back, or Trump came back and said that China already violated that understanding that they have. And so the other ones are starting to stall. So I think in order for the market to really, stick its heels in the ground and move forward, someone's going to have to say, here's the deal, it's done, we're going to sign on the dotted line.
But those aren't forthcoming anytime soon, it doesn't feel like, right? Because everything that we've had, to your point thus far, they've been these sort of memorandum of understandings,
Correct.
if that, or just an agreement to work on an agreement.
Correct.
And as we know, and we've said many times, these trade agreements can take weeks, they can take months, they
Right.
can take years. So what does that mean
Right.
then?
So we're hoping it doesn't take years, right? Because that would be a problem. But the EU already came out. Remember when he threatened on the EU, they came right back. Ursula von der Leyen came right back and said, they're going to fast track some of these trade talks. So I don't mean that, they need to have one tomorrow, but they absolutely have to have more than this memorandum of understanding like they had with China 2 weeks ago when everyone thought, okay, it's all great. Now we got China. China really wasn't in the hopper yet, right? They just kind of were laying the groundwork for more talks. You need to see just more than that in order for the market to really.
Is it your sense, though, Kenny, as we wait for the big deal, if it comes, that the market is getting a little numb to the Trump on-again, off-again proclamations? I ask because Dr. Ed Yardeni was writing about that in his morning note to his clients.
Right.
That he was saying, it feels to him like the stock market is basically barely reacting anymore to these proclamations.
And it's funny, I said that in my note today, too, that I thought that the market was starting to look through all this trade noise and start to really once again focus on the macro data, the hard data and the soft data, because it feels like, fool me once, shame on me, fool me twice. Fool me once, shame on you, fool me once, shame on me, which is what I think the market is starting to feel with these trade talks. Every once in a while, he raises the bar and he makes all this noise. I think people are getting numb to that, and they're really just kind of looking through that because the robust data is not falling off the edge. The hard data remains
Do you think is a smart move to stay a little numb, a little indifferent, to look through?
I think you have to look through because I think the trade deals are going to get done. Look, these countries need us. They need to come and trade with us. So these trade deals have to be renegotiated, and it's actually okay to renegotiate trade deals that are decades old. The world changes, everything changes. Like everything, it needs to get rewritten, and that's okay. And so I think the sense is that most people feel the trade deals will come. It's not going to be as onerous as maybe they thought it was originally going to be. And so you have to start to focus moving forward, which doesn't mean you shouldn't remain somewhat cautious because, any headline could really send us tumbling if it's super negative, right?
Yeah. Well, we could have a whole hour discussion about whether the trade deals all need to be negotiated at
the
once.
same time. Correct.
But that's another topic.
The style, I agree.
So I want to ask you about something else, and that's what we're coming off of, right? Really strong May for the S&P 500. June does not tend to be as strong, right?
No.
So what does that mean?
Well,
what should we
listen,
be on the lookout
June
for?
is also the end of the quarter, don't forget, right? So it's the end of the marking period, right? May wasn't the end of the marking period. June is the end of the marking period. So
that's when it counts?
Well, because that's when, when everyone sends out their quarterly letters and they show everyone what they've done for them and all that, right? So they were a little bit more cautious in June. But don't forget, May was very strong because we came off of a very weak April.
Yes, of course.
Right? So April got crushed, and so the rebound in May really just took us back to where we were. Remember, if you were somebody who didn't do anything to your portfolio from April 1st to May 30th, you were in the same place, right? You didn't lose, you lost in the middle of the month, but if you fell asleep and you looked then and then, you're almost at the same place, if not actually a little bit better. Some of these names are higher than they were on April 1st, right? And so that rally back was really just took us back to a level we were at. Now I think it's going to struggle a little bit, right? Not in a bad way, but I think it's going to churn some. And if it backs off the trend line, that would be about 2.5% if it went back down to where trend line support is, which I would not be surprised if it does. And if it doesn't hold there, then it's going to fill the gap that it created on, I forget the date was, May 12th or something, I think, which would be back at, I think it's 56.90. It might fill that gap if it doesn't hold at the trend line, which again, I wouldn't necessarily think is a horrible thing to do because it's only about down 3.2%. So it's not like it's down 15%. And so I think it would also be healthy. But until we get more of the trade deals, and like you said, June is a month that typically is not such an outperformer, but for me, it's also the end of the quarter. So I think that adds a little bit of cautiousness.
As a longtime trader, as someone who's been watching the market a long time today, were you surprised by buy how big that rebound, how ferocious that rebound was off the April low?
You know what wasn't so surprising about that is because all the names that got crushed on the way down were the high flyers. So they were naturally the first ones. The minute there's any sense that the deal's going to get done and look what we have, the high flyers are going to come right back, which is exactly what happened. The Nasdaq way outperformed the S&P and the Dow, right, on the rebound. But they were the ones that also got hurt the most. So the fact that they rebounded like that does not necessarily surprise me because, again, look where we are. We really didn't go anywhere because we're really in the same place, right, that we were on April 1st. So, yeah, we had this move down and up, but now we're still kind of just churning along here as we await the trade stuff, the Fed stuff, and eco data.
So what do you do?
So I think it depends on who you are. If you're a trader, you're just going to trade like you usually do. Listen to the noise and trade around it. If you're a long-term investor, you stick to your plan, right? You take advantage. You continue to make your investments as you make them, monthly, quarterly, annually, however you make them. I think you continue to make them, and you just tweak around the edges, right? You don't get yourself. You maintain your tech exposure, but don't get yourself overweight tech exposure. Again, it depends on who you are. As a 60-year-old, you want to be a little bit more cautious. But if you're 30, you want to be all in on tech. You've got 40 years in front of you. I don't necessarily have 40 in front of me. I'd be lucky if I have 10.
Oh, come on, Kenny, for goodness sakes. Wow, you're such a positive guy. All right, Kenny Paul Carey, who's going to be with us for the next couple of decades talking to us about stocks. We're just getting started here on Market Domination. Coming up, Tesla shares are under pressure as sales for the EV maker continue to slump. We'll hear from an expert on the other side about what's next for that stock. Stick around, much more Market Domination still to come.
Tesla shares under pressure as sales for the EV maker across much of the European market continuing to slump. Yahoo Finance's Praz Submarinian joins us now with more. Praz.
Yeah, 4 or 5 months in a row now we've seen weakness there, and some new numbers came out recently from the various sort of auto bodies that are in European countries, and they talk about registration data because we don't have official sales data, but the numbers are pretty staggering. France down 67%, Sweden 54%, Denmark 30%. Well, we touched on Norway. For some reason, Norway up 200%. Really interesting. I also read Austria.
Yeah.
Musk, was tweeting about Austria being higher. So, you had a couple things at play here, right? We had the new Model Y coming out. That may have helped sales in Norway. Unfortunately, the cheapest version is not out yet fully in European markets, so we'll see that happen. Maybe that'll goose sales up a little bit. But, the trend is unmistakable. The last 4 or 5 months, it's been very negative, very bad, down a lot, tumbling here. Is it new competition? Is it the Musk effect? But it's not EVs. EVs are actually up. Sales are up in the European markets, not because of EVs. So something's going on there, and it's a Tesla and/or Musk problem.
And we know that, for example, BYD outsold Teslas, didn't it? Was it in Europe in April? I can't remember what
exactly. In
was.
April, we saw that first time it crossed over the pure EV sales of BYD's top Teslas. Volkswagen's EVs are selling more than Teslas are.
I actually was interested on that, Praz. Is it also, are you seeing more European competition?
Yeah, for sure. And maybe you're seeing people substitute towards the European competitors as an option. VW in particular has been introducing more and more new EVs, cheaper EVs, better EVs. So yeah, there's a lot going on there. Audi, BMW too. So not just Tesla.
Interesting. Thanks, Praz. Appreciate it. For more on what's ahead for Tesla sales as Elon Musk prepares to make a full return to the company, let's get to longtime bull Dan Ives, Wedbush Securities Managing Director. Dan, it's great to see you here. So draw the line for me, if you would. What does Elon coming back to the company full time do for European sales? How does he fix that problem?
Look, I think the biggest thing with Musk coming back is around leading the autonomous vision. To me, that in terms of the AI vision when it comes to autonomous robotics, I think that's the most important thing. That's 9% of the future value. In terms of Europe, China, US, look, Musk being there in terms of, first off, the brand damage, I believe now is contained, and most of that is in the rearview mirror with him out of the Trump administration. But then it's going to be about rebounding sales in these regions, guiding to the next page of growth. But Julie, to me, the biggest thing here, it's much more about what happens in Austin late next week than Europe sales down in a month.
Well, but it's still how they make most of their money, right? The vast majority of their money is made from selling cars. When does that rebound happen? Do we have to get to a year out where they're going to be lapping these declines? Or do you see some kind of rebound happening this year?
Yeah, look, I think second half of the year, you'll see a rebound in China, a stabilization in Europe. So, we'll call it less bad specifically in terms of some of the other countries. And then I think in the US, I think you'll start to see a rebound, especially with some of the refreshers starting in 3Q. So you combine that with what ultimately we see when it comes to autonomous and robotics. I believe a golden age is ahead for Tesla. And that's why we don't worry too much in terms of month to month, some of these things that we're seeing coming out of Europe, relative to our bullish view where this is heading over the coming years.
And Dan, if you look at the stock, it's had a nice move over the past month. It's up about 20% here. What do you chalk that move up to, Dan? Is that the Musk return? Is it the robo-taxis coming to Austin that you're referencing?
I think it's the Musk return, right? It all goes back to, we've talked about it. We were doing Julie in the show. Once Musk recommitted to Tesla, days in the White House were done. Tesla got back its biggest asset. And then that coincides with what I view as the biggest error for Tesla in its history in terms of the AI future. I think when it comes to autonomous robotics, I think autonomous alone is worth $1 trillion to the market cap value. And I ultimately believe there's a $2 trillion market cap.
I have to ask you about this Reuters report that came out today. I don't know if you saw this, Dan, but I'm sure you remember last year, Reuters reported that Tesla had abandoned its project of developing a cheaper alternative, right? A cheaper model. And Musk came out and tweeted, Reuters is lying. And the Reuters report today says internally there was mass confusion among management because they had abandoned the plan. And so they were like, but wait, does that mean it's back on? What's going on? And I ask about this because it speaks to the ongoing issue about Musk's credibility, whether it's internal or external to investors. So he's obviously put a lot of eggs into this autonomous basket, into this cyber taxi basket. How do we know if we can believe him that it's going to work?
Yeah, but Julie, I think to that point, that's why this is such a key few weeks, few months, and I think a year ahead, because it's not just about what we see in Austin. It's about the 15, 20, 30 cities that I see robotaxiing over the next year. This just starts, the birth of that vision starts next week. And to your point, look, there's going to be many that will be skeptical. But Musk and Tesla have been here before, back against the wall, proven it again and again. And to that point, in terms of the lower cost vehicle, look, I think that was a decision they had to make. In other words, do you go after, what we'll call it the next gen skateboarding vehicle? I think they decided basically to do more of a refreshed, cheaper Model Y. But I don't think that that's done. In other words, that cheaper sub $30,000, $35,000 vehicle will still come, just not when investors thought.
And Dan, we're talking Tesla. I also want to get your thoughts on another big name you cover, which is Apple. Their big software show, WWDC, that kicks off next Monday. Dan, what do you expect to hear at that show? Dan, what do you want to hear?
Yeah, and look, and you know it so well, Josh, in terms of Apple. What we expect to hear is laying out the framework and the guardrails and the vision for developers for the AI strategy. If you go back to a year ago, obviously there were definitely a lot of speed bumps to where we are today. It's given developers what the roadmap and the framework is when you look at next year. And that's the most important. That's the hearts and lungs of Apple. Look, Apple obviously is caught, in tariff sort of storm here. But to me, that doesn't change my medium or long-term view of Apple. You still have best install base in the world, 2.4 billion iOS devices, 1.5 billion iPhones, and the developer network that continues to be, that's who Cook's talking to next week. And I think that's the important thing, because the consumer AI revolution goes through Cupertino. The enterprise AI revolution goes through NVIDIA, Palantir, obviously others. Consumer AI revolution goes through Cupertino, in my opinion.
And so let me ask you, Dan, because I don't think I got your take on this. When you heard, by the way, that Sam Altman and OpenAI were buying one of Johnny Ives' startups. Johnny Ive, legendary, of course, Apple design guru. How much of it all do you consider that a threat to Apple?
See, I don't view it as a threat. I just view it as the strong are going to continue to get stronger. Big tech, I mean, even though like OpenAI obviously partners with Apple, I mean, when you think about it, no one is going to just sit here on the treadmill. Everyone's going to look to acquire because it's an arms race. It's the fourth industrial revolution. I don't view that as competitive, but it speaks to all men OpenAI. They're not just going to look at where they are today, how they get stronger. Alphabet's doing the same thing, Microsoft as well. And I think Apple, this is a key moment for them to basically say, don't forget about us when it comes to AI.
Dan, always great to see you and to have you on the show, my friend. Thank you.
Thanks.
Walt Disney is laying off several hundred employees in film, television, and corporate finance. For more on the recent news, let's welcome in Yahoo Finance's Alec now. Alec.
Hi, guys. Yes, Disney confirming this to Yahoo Finance, saying the cuts are part of a broader push to streamline operations as the company adapts to a rapidly changing media landscape. Like you just mentioned, impacted areas include marketing for both film and television, TV publicity, casting and development, along with corporate financial operations. Disney said it's taking a surgical approach to minimize the number of employees affected, emphasizing that no teams are being eliminated as part of the process. Now, shares were little changed on the news, but this latest round does follow a series of earlier layoffs at the company. Since 2023, Disney has cut more than 8,000 jobs in an effort to reduce annual costs by $7.5 billion. Earlier this spring, the company slashed nearly 200 jobs in its news and entertainment division, mainly impacting ABC News and leading to the shutdown of 538. And we know there's been a major push to streaming across all of these traditional cable players. That's what's fueled a lot of these job changes. In its latest earnings report, Disney said that they saw a 13% drop in linear network revenue, while direct-to-consumer revenue jumped 8%. So we're seeing that sharp pivot to digital continuing to play out. We're also at a time where a lot of these companies are looking at AI efficiencies and trying to really fix their balance sheets and streamline operations, like Disney said. The stock, though, has been on a tear since the last earnings report. We're up over 20% since the past month. So we'll see how things continue to play out here. But for now, it seems like the financial story for Disney is intact, and they have other growth areas to lean on, but that often means potentially some job cuts to come with that.
All right, thank you, Allie. Appreciate it. Coming up, we're checking in on some of today's top trending tickers as shares of Applied Digital. They're soaring today. Stick around. Much more market domination still to come.
Yeah.
Big tech making a meaningful contribution to the S&P 500's rebound from those April lows. However, our next guest keeping a close eye on several risks looming for the sector. Ted Mortensen, Bayer Tech strategist, joins us now to discuss. Ted, always good to see you on set.
Good to see you.
I want to start that last time we spoke, which I think was roughly about a month ago. I remember you noting, you were highlighting how negative sentiment was when it comes to tech. Has that changed at all, Ted, since we last spoke?
Yeah, it changed. I think if you go back to April 7th, when the VIX was at 60, people just got too pessimistic. And they were very much underweighted tech. And I think when Q1 earnings started, it became very obvious that, you know, we had more, I would say, performance in front of us. And there were a bunch of names that we're screening. We run a sentiment index that is pretty accurate. Everything was flashing by around the 7th of April. Now, what people are trying to do is they're trying to get equal weight in certain names, and it's really kind of a FOMO trade where they've just been caught flat-footed on having their exposures too low.
Well, I'm curious if they went too far in the other direction. And I was looking at some numbers from DataTrek that show that 62% of the gain in May came from the Mag 7 specifically, with the exception of Apple, which was actually off. But besides that, NVIDIA and Microsoft were the two biggest contributors. So I guess now, how is tech priced considering the outlook?
I think in the near term, we really have to look what happens. If you look at Liberation Day, it was April 2nd. So Q1 earnings really don't mean a lot. I mean, we're going to have to see how all the tariff impacts hit Q2 and Q3. We won't know that. Our technology conference is in New York this whole week, and I'll be looking for what management says on sentiment. They haven't seen it yet, but if if the visibility in the second half and into the tail end of 25 gets murky, I think we'll mark time here.
Today, of course, one big dynamic in the market is trade tensions, and it's U.S. and China, again, kind of flaring up. We have Washington, Beijing, they're kind of throwing barbs and accusations. Who's responsible for violating this, at least temporary trade agreement? I'm just curious, as a tech investor, how should you think about the opportunity long-term in China? I mean, is it still the big opportunity a lot of people used to think of it as, or no, you should adjust your expectations?
You should adjust your expectations. This is a national security issue for the U.S., and I think there's two.
And so it doesn't matter who's in the White House?
I think it matters, but President Trump is using generative AI, for example, as a bargaining chip. Look what he did with the Middle East. But more importantly, look what BIS, they went after Synopsys last week, and that's roughly 12% of their total revenue in China. So, and then you leverage on what we learned from NVIDIA, $4.5 billion write-down on the H20. That's a big issue. So we're not playing games here. This is more, I think, as a national security issue than as a commerce issue.
Do you think that the street has properly factored in not just the trade thing, negotiations specifically, but more broadly the geopolitical environment that we're in?
Not a chance.
I mean, what should they be considering? How should that be factored in?
It's such a binary event, but what happened yesterday in Ukraine and Russia, we were talking about earlier, that's a major, major issue as far as global tensions, because it was on Russian soil, and it also took out a portion of their strategic triad. So that's a big, big deal. And if you look at what, even from the Biden administration, the Trump administration, we're at economic war with China right now on just restricting technology. China can't get 14 nanometer and below equipment. Now we're looking at Gen AI because the magical node is at 2 nanometers, and a lot of that next generation AI technology will be at that node, and we're restricting everything we possibly can against China to get there. So.
And when NVIDIA reported, though, Ted, and listen, they laid out, hey, here's how much of a hit China's going to be. Investors, I mean, they still bid up that stock. I'm just curious what you made of that report. What did that report not just tell you about NVIDIA, but just about the broader AI trend and theme?
It's a run. The genie's out of the bottle. And some of your guests previously have indicated that Gen AI explosion. This is probably one of the biggest builds in the history of technology. I think what got NVIDIA going is some of Jensen's commentary around agentic AI. The loads are amazing. And in software, we're just starting agentic AI. And that's a paradigm shift in software just to begin with. But when President Trump decided to give the Middle East access, whether it be Saudi Arabia or the UAE, that was significant because that takes CapEx to a whole nother level that we haven't really been thinking about. And so I don't know how many billions of dollars of it, but it's significant.
To that point, there were some skeptics, Ted, who've been on the show and said 2025 could be kind of the high watermark of AI spend. This is it. This is the peak.
I think I disagree with that because I go back to the national security issue. Every single country, Europe is in trouble right now. They're 4 or 5 years behind us in Gen AI. If I was a minister or head of the EU, this is going to be a national security issue and how they defend themselves. Because if you look at Palantir, you look at Anduril, all these next generation companies are using software, and Gen AI is the new weapon. And I think if you look at these sovereign data centers that have to be built, it's maybe not what people are really focused on right now.
Well, and Ted, and by the way, you're speaking from experience here in terms of national security. You were a naval aviator. You served with the Joint Chiefs as well. So you know whereof you speak. I want to come back to the Middle East and just to leave it here. What is the risk, though, that another administration comes in and says that relationship is a national security threat?
It's always a risk. You can't, this is like playing chess on 4 levels. You just don't know which level to play on. I don't have any insights on that, but you have to deal with the facts we're given right now. And he opened up the kimono. So the genie's out of the bottle.
Yeah, definitely. Ted, thank you so much for coming in.
Great
Good to see you. Now time for some of today's trending tickers. We're checking in on shares of Applied Digital, Dell, as well as some solar and hydrogen stocks getting hit today. First up, we've got Applied Digital. Those shares soaring today after it announced 2 long-term lease agreements with CoreWeave. Now, those leases span about 15 years. Applied Digital expects it to generate around $7 billion in total revenue over that period of time here. And Applied Digital has been converting itself to a data center real estate investment trust. So this is part of that process. This deal is part of that. And obviously, there's still been, as we were just discussing, still big demand for data centers.
Yeah, I see analysts at Needham side is saying this is a good deal to get cash coming in. A lot of love for Applied Digital by way on the street. Here's something you don't see too often, Julie. There's nothing but buys on this name. You got 9 buys, 0 holds, 0 sells. Maybe it's bullish, or maybe it's a contrarian indicator. I don't know. Take your pick, Julie. Stock has already had a nice run this year. We're up around 30%. You're up around 160% over the past 12 months on this one.
And also, you know, I mentioned that they signed the deal with CoreWeave. CoreWeave shares are trading higher as well in today's session. Now, recall they went public just in March at $40 a share. CoreWeave today, as I squint, 118.50 or so. So not a bad little return on the CoreWeave.
No, for sure. Shares of Dell sinking today, meanwhile, after a report that the General Services Administration contacted 10 technology providers Wednesday, including Dell, asking executives to justify their work and find areas to cut. This is according to the Wall Street Journal. So you saw CDW and Dell, they were under pressure both in today's trade, and it was off that Journal report from this GSA apparently sending this letter, listen to these providers, ask them, listen, justify your work, find areas where you can cut costs to the U.S. government. I did see some analysts weighing in, though, on at least some of these moves. For example, I did see team at Evercore, that's Ahmed Daryanani, he weighed in telling his clients about CDW, at least specifically, saying he thought that stock reaction overblown. He said, in fact, limited exposure to the federal government. We don't expect CDW to lose all of its Fed business. They remain outperform on that one.
Yeah, it's been really interesting to see these cuts make their way across companies. Accenture was hit. Booz Allen Hamilton, which is a huge government contractor, gets most of its revenue from the government, affected by that as well. And I was really struck by the tally that was in the Journal article. They say since January, the federal government has canceled 11,297 contracts across 60 agencies. That's gotten them $33 billion in savings. Also, speaking of government hitting stocks, we've got solar and hydrogen power stocks like Sunrun, First Solar, Plug Power. They're all lower today. That's after the Energy Department canceled over $3.5 billion worth of grants for clean energy and climate projects. And this coming in an announcement from U.S. Energy Secretary Chris Wright. He said 24 awards were being canceled there, and many of them were signed between Election Day and January 20th. According to his order, almost 70% of those were signed at that point in time. Presumably, the intimation here is that they were being rushed to sign them before Trump took office in order to sort of lock them in, and now the Energy Department's reversing them.
Yeah, there was a good meaty piece in the Journal about this too, which was sort of just delving into looking broadly the different subsectors and verticals, how in this industry, how they're having to navigate just so many moving parts right now with policy changes and tariffs and import restrictions. You know, a previous administration that was sending in billions, just a new financial chapter here without as much public support.
Yeah, and it's interesting because, you know, all the CapEx that we have been talking about from large cap tech, they are still putting money into some of these solar projects because they need the power for their data centers. Nuclear's not up and running yet for those projects. You know, yes, they can get natural gas powered projects, but it's really hard to get new turbines right now. If you haven't ordered one, it's tough to get them. So, you know, solar is still an alternative for those companies. So we'll see how it all plays out.
And you wonder, as public support changes, Julie, does more building shift also to different countries, different regions, right?
It might, yeah. I mean, the incentivization is different, like in Europe, for example, certainly than it is here. Well, coming up, could the Ukrainian drone attack over the weekend spur the next chapter in the Russia-Ukraine crisis? And what is that going to mean for the markets? We're going to speak to an expert on the other side as tensions escalate. Stick around, more market domination still to come. What I want to ask you is about the market interpretation of all of these events. Now, you and I have talked a lot before about how markets do tend to shrug off a lot of geopolitical tensions, right? Even an escalation or re-escalation, a hit like this. What do you think? Does anything change in the calculus of this war that would change sort of how markets view it?
Well, I mean, it would change if this brought the Russians to the table to bring the war to an end. And so far, of course, Putin's perspective has been the longer this war goes on, I'm Goliath and, to David in Ukraine, and I'm going to beat them. I can outlast them. I have more troops. I can destroy their morale. I'm in a dictatorship. I don't have, sort of the need to speak honestly with my own citizens, all of those things. But if it looks like Ukraine's own military capabilities with their own drones, these didn't come from NATO, these were made in Ukraine at a cost of $300 to $400 each, can take out bombers that cost $100 million. I mean, that's a 100,000 to 1 return for little Ukraine. Well, if that's the kind of thing that over time threatens Putin, threatens his country's geopolitical position, then there's a greater likelihood that the war's over. And if the war's over, then we can talk about sanctions being taken off. If sanctions are taken off, the markets, of course, are going to respond significantly to that. Now, we're not there, but it is clear that, it's very interesting. These attacks happened right before, the day before, the Russians and the Ukrainians were meant to meet in Istanbul. Ukraine knew that. They wanted to show that they actually do have some cards to play. And the Russians still showed up. They still negotiated. They talked about prisoner exchanges, which isn't new, but is important in the context of these attacks, and also even put a new offer on the table for what might bring a ceasefire, where the Russians did show movement. There's still no common ground between the two countries, but Russia today is actually in a closer space to Ukraine diplomatically, incrementally, than they were before the Ukrainians attacked Russia. So all of that is certainly information that market participants are interested in hearing. It's relevant information for them.
So Russia, Ukraine, Ian, front and center, but also in today's trade, for sure, investors were focused on the back and forth here between Washington and Beijing, trading these barbs, trading these allegations. Ian, you saw it. Who's responsible for violating this temporary trade agreement? We also had a report that Trump and Xi likely to speak this week. I'm curious how you see this playing out, Ian, and who do you think ultimately has the leverage here? Is it the U.S. or China?
Well, the latter is, of course, the most important question. At least in the first couple months since Liberation Day, the Chinese have shown that they have more leverage. They will take more economic pain than the U.S., so they are in a worse economic position. But politically, they are run by a leader without term limits, by a monopoly party that controls power, the Communist Party of China. It's been there for decades and decades. So, and Trump has checks and balances, even though he's trying to weaken them somewhat successfully. He's 78 and he's only there for one more term. So, you put that together, and China's been, their perspective is, we don't need to pick up the phone. We don't need to back down. We know that the Americans are trying to contain us. And so, this is not a place that we're prepared to capitulate. And the taco trade, as it's being called, it doesn't apply accurately to countries around the world. Most countries are not China. Most countries are weaker than the U.S. substantially, and they capitulate. But China is a different story. China is not capitulating. China is saying, we are prepared to stick unless you guys behave. And that includes on critical minerals, which a U.S. and its companies desperately need if they want to have effective industrial policy. So I do think this call between Trump and Xi, which is way overdue, is going to be incredibly important, much more important than Trump's call with Putin that lasted a couple of hours, much more important for the global marketplace, frankly, than any call or meeting that Trump has had since he became president back in January.
Do you think it's actually going to happen, Ian? The
fact that it's been announced implies that it's going to happen. I think that, I mean, Xi Jinping, this is already planned and well approved. If it doesn't happen, it'll be because Trump pulls out, not because the Chinese do. And I'd be surprised. Trump personally, when he speaks about Xi Jinping, not about what the Chinese government is doing, not about Chinese intelligence, cyber attacks, visas, students, you name it, but Xi Jinping, Trump has always shown a level of respect and even deference. He would never treat Xi Jinping the way he treats, say, Justin Trudeau, right? Never. He would never do that. And in that regard, I mean, he said that I think he's a strong leader, he's a smart leader, he governs his country effectively, all of these things. I expect that the call will indeed go ahead.
You mentioned the taco trade there, Ian. So referring to this acronym that I think the FT came up with, Trump always chickens out. Now they came up with that, Ian, kind of referring to the Trump tariff. I am interested in how you think that might apply to the world you know so well, the world of geostrategic relations, and whether you think a lot of our foreign adversaries at this point kind of might think of Trump that way too, that he huffs and he puffs, but at the end of the day, he's not likely to pull the trigger. He's not likely to try and blow your house down.
Yeah, I think it applies equally badly to geopolitics as it does to trades around the world. I love the fact that it was come up, the taco trade was an FT writer. It helps explain why Mexican food is so bad in the UK. I think that on the geopolitical front, Trump has shown that he doesn't have the cards to really push Putin around. But other leaders around the world, I mean, Panama Canal is all about geopolitics. Trump has said he'll destroy these guys if they're not prepared to actually, make way and give in to the American military. And despite the fact that it's really going to hurt the Panamanian president at home, he folds. And I think that the U.S. has had a lot more success. For example, with the Iranians and with their proxies, like the Houthis in Yemen, than he has with Russia. So like so much in the world, it's not about whether Trump is an apex predator or whether he's a coward. It's about whether or not there's a major asymmetry in power in who Trump is dealing with, and do they have the willingness to hit back? And many countries and many companies and many CEOs around the world are weenies when it comes to Trump, and understandably so. So I think it really depends. I know that doesn't make for a great acronym. It depends. I know it doesn't make for like a great soundbite. It depends. But the reality is, like so much else around Trump and very aged people in the world, it depends.
Ian, something that you talked about in one of your recent notes was the dramatic remaking of not just global trade, but sort of the U.S. economic place in the world that Trump is trying to embark upon. And just sort of, I was struck by how you put it in historical context and said this is really quite unusual what Trump is doing. What makes it so unusual? And given, as you said, this is his last term, does he have a chance of success, whatever success means, at doing that?
What's unusual is that the U.S. is undoing its own role in the world. The United States, after this present world order was built by the Americans after World War II, which we almost lost because we came in so late, and it was forestalled by Charles Lindbergh and the America First movement that at the time said, don't fight the Nazis, that's in Europe, it's not our war. Well, Pearl Harbor happened, we decided that was our war, the Europeans were our allies, the Brits and the French, and we wanted to support them, and ultimately we won, and then we chose leadership, and that's why we built all of these institutions, that's why we did the Marshall Plan, that's why MacArthur went and rebuilt Japan. Now, when the Soviet Union collapsed back in 1991, we were no longer leaders. That leadership was something we inherited. We were winners. And Trump, as a president, really reflects that shift. He's not a leader. He's not interested in leading other countries around the world. He's not interested in being in charge of collective security or free trade or promoting democracy or rule of law. Trump is a winner. He's worth billions. He wants everything about himself, and he wants other countries and all of his advisors and all the corporates out there to tell him how great he is and do whatever he wants. And the strong can do what they will, and the weak will suffer what they must. And so what's happening is not what the geopolitical analysts assumed over the last decades, that the US was in decline and China was rising and we would fight because we'd be in a Thucydides trap. No, actually, the US is not in decline. The US is economically, militarily, technologically still quite strong. Its allies are much weaker. They're much more vulnerable. They're much more dependent on the US. So the relationship between the US and its allies has become more asymmetrical. China has become more powerful, and the US has unilaterally decided, for lots of structural reasons that have been coming for a good long time, that the US no longer wants to be constrained by the leadership that our forefathers put in place. And as a consequence, we are going to undo that domestic order and that global order. And Trump, in that regard, is quite a revolutionary figure. And the question is, as you say, how successful he will be in making those changes. I suspect his success will be limited because Trump is not a dictator. He is 78 years old. There is an independent judiciary in the United States. It is a federal structure with blue and red states that act in many ways autonomously from the federal government. And those things resist a revolution from above.
Right. And I'll let people Google what a Thucydides trap is, which I will be doing also. I know you referred to it in your most recent note.
Rising power, declining power leads them to fight. That's what it is. Happens historically, usually leads to war. Hopefully this time not so much.
Fingers crossed. Thank you, Ian. Appreciate your perspective as always.
Be good.
Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.